Yes, good morning, good afternoon, everybody. So today is 1st of April 2019 to look at risk management. So today's webinar is going to be one simple one. We are basically going to look at the strategies that one can look at when they want to. So I've noticed that most people have a good strategy, but the only part that is letting them down is that they don't have a proper risk management. So even as you are developing a strategy, you have to ensure that your strategy is taking into account the risk involved in every trade. So we don't just want something that gives money and then all of a sudden it loses everything. There's a strategy called Martingale strategy. So I'm not advocating for that strategy at all. I'm not in any way advocating for Martingale strategy at all. So the main reason is this. What Martingale means is that every time, assuming I come to this place, maybe something like this. If this was a level, this was just some minor support here, then price went below, it came back to the same place, then I picked the first sell from somewhere here. This is the first sell. That is the first sell. So after selling here the first time, price instead continues to go up. So instead of going down, it needs to go up. Then at this point, when I was selling the first time, maybe my volume at that particular time was 0.01. What I'm trying to illustrate how Martingale works. So somebody would sell their 0.01. Then when the price gets somewhere here, if he lost this trade, maybe stop loss is somewhere close to this point, then he has been stopped by this one. Then he goes to the next place, then enters a second sell. Second sell, now at a double volume. Second sell at 0.04 maybe. He enters there. Then he now sits back and says that if this trade is stopped, maybe stop loss has been hit from this point, he expects to sell again from this point, somewhere around this resistance. So such a person, that is one strategy you don't want to find yourself trading, where you'll sell here 0.01, then it stops you. You go to the next place and then you sell again, it stops you. Then you go back again to the next level, third time, third sell. And because previously you've been losing, now sell this one 0.10. Yes. Then if the third one now fails, you say the next key place, the next key level which I'm seeing is actually this one. So because you add the volume of this plus this is 105, then you also add this one, and then you realize that you have lost at least 0.15. The total volume which you've been trading is 0.1. So you want to pick a sell from this point in a way that you'll earn everything you've lost. That means the last one here has to be bigger than all the three put together. So this one, you'll find yourself trading also that one at the fourth one, fourth sell, and because you will lose the others, you now place 0. This is 0.5. 0.5. So if you want to find a clear definition of gambling, this is what is called gambling. It is not based on anything at all. The fact that you are saying that by selling a bigger volume on the subsequent ones does not mean that they'll go your way. Sometimes the market may go against you indefinitely. Like assuming the overall trend in this case is upward, then you find yourself selling this, you again sell the next one. When this one is stopped, you sell another one in the hope that at least one of them will go your way. It will work most often, it will work. But then the day it stops you, you lose everything. So we don't have some, this is called Martingale. It's not the best strategy for anyone. This is one thing you need to avoid. As long as when you're coming up with a strategy, just ensure that your strategy is not based on this. A good strategy has very clear risk defined. Like you need to define very well that how much am I going to lose from this trade? I expect to lose this amount of money. Then if that loss is incurred, take it as a man. Like you take it as a trade. That's the nature of any business. There's no business where you'll be making money indefinitely. At some point you have to lose, at some point you have to earn big, but then you have to ensure you cut your losses. So whoever trades like this, if somebody tells you that you should enter the first one, if this one does not work, you enter bigger volume. If this one does not work, you enter even a bigger volume. If this one does not work, you enter even a bigger one. And if this one does not work, does that mean now on the sixth one, on the fifth one, you now place a bigger volume? Is that the case? I don't think that should be the case, because you may end up losing your entire account just trying to sell the same symbol. The best you should do, instead of, if you have to trade something that looks like Matiangal, then if this is 0.01, the next one needs to be 0.01. The next one needs to be 0.01, and even the third one needs to be 0.01. That way you reduce the risks involved. Like you don't have to find yourself entering a trade in a manner that if that one trade loses, you actually lose everything you've been earning. That's one thing we don't want to get ourselves into. So the most important thing normally in any strategy someone is trading, the most important thing is to get, first of all, find a strategy that controls your risk, and that strategy must not be based on Matiangal. Matiangal is simply what I've explained. Avoid using this strategy if you're trading CFDs, contract of difference. Anytime you're trading CFDs, never find yourself trading this. This is only good in markets where that are consolidating, but I don't recommend it in any way whatsoever. So there's one thing which I noticed, that while it is true that the main pairs are the most traded, the main pairs like this ones, show hide all first, then show all. It is true that the main pairs are the ones that are traded mostly. It is also true that CFDs are traded mostly. Like if you want to make money correctly, look for charts that are a bit clear relative to the others. Like if somebody tells you to trade this is gold, I have it weekly, this is what I'm looking at, you may not be able to understand whatever is happening at the moment. You are at least for now, we are saying you should not be able to if you don't understand what's happening on a particular chart, even if that's the main pair, don't trade it. That is one way to reduce risk. Like if you find a chart that looks like this and you don't understand exactly what the chart is saying, leave it, even if that's the main pair. You don't have to trade it just because it's called the main pair. Move on to the next chart, like that one. Look, if is it giving you the correct picture? No, you leave it, you move to the next one. So one thing I've noticed is that somebody would take a very good long time trying to trade this one while he's leaving CFDs, and these ones are clear and they are long-term trades. Like if you enter one of this one, this or this one, French stocks index, you realize that you could have made money indefinitely simply by following a particular trend. Like there is this, just a second, show you what I'm saying. Just look at how this is clear. So I want to log into place live account so we are able to see widely what I'm saying. Show see if we are here. Just a second here. It's clear. Looking for an account that has more data, not just a second. So that's the most important thing. Just ensure that your charts are very clear. Don't look for charts that you're finding it hard understanding whatever is happening. If you're on a chart and you don't understand whatever is happening, the number one step is leave that chart. Simple. leave that chart. There is no point of trading a chart just because it's a main pair or it's a main symbol or you heard somebody talk about it. There are several charts that are clearer. At every given time, there's always one chart that is clearer than the other. Your job is to get that which is clear. Just a sec. Get that, at least I need chart that has a lot of data so that we are able to see whatever I'm saying. So we have SP500. So just look at this chart like this. This is since 2008, like 10 years ago. This symbol has been actively upwards. The trend is clear. Everything is showing you that we are actively heading side. Everything is showing that you are heading to the upper side. We have the trend confirming the same thing. And if you add this indicator, which is this, okay, notice that the overall trend is still upwards. We have the columns of MACD above 00, and the signal handle MACD is also above 00. Then if you attach another indicator, which is a moving average, it's also showing us, sorry, it should be 2. It's also showing us that we are upwards. It's also upwards. Then I'll add another indicator, which is average directional movement index. This one also is showing us for a good time that there's an active trend. The complete line is above 25. Then the main line, the green line is above the red one, which means all this time from this point here up to where the price is now, this indicator has been showing us that the price is heading to the upper side. So if you find a chart that looks like this, that is almost obvious that in the next 1 month the price is going that direction, it's better you deal with that one. It's really, really good you remain with such a trade. Don't find yourself selling anything or buy anything just because you show somewhere that chart is the main chart. It's a main symbol. Don't find yourself trading anything like that. So another thing you need to avoid is the idea of trading anything. Like, you see the way this chart looks, this is a bit clearer. We looked at it some times back and I think it's still the best one in my opinion. I did mention something like this. You can literally see from observation. You don't have to know many things. You can see those instances when price went below, when the columns of MACD actually went below 00. That point. We also have this point here, and then we also have this point. The second, we also have this point. Then we also have this point here. So the number one way to reduce your risk is to ensure that you look at everything that is in your direction. Like if you're seeing a buy on the main chart, try to confirm with this one and only settle for setups that are a bit obvious. If a setup is not obvious, you don't trade it. Like if you don't understand whatever is happening on a particular chart, it's not obvious for you, leave it. And assuming you've noticed something like this, that every time the columns of MACD are below 00, they actually spend very less time below 00. And anytime they break above, like in this case from this point here, they actually remain for an extended time. Then it remains some few days, and then continues up for a long time. Then some few days before it continues for some time, and then there's this few days we were below, and now from the past we know that the price is heading upwards. If you can evaluate a chart that way, then that's the correct chart you're supposed to trade. That's the number one step towards reducing risk. It's not all about knowing that I'm supposed to stop my losses at this amount, I'm supposed to take my profits at this amount. That's not the thing. You have to come up with a clear strategy. You have to, this is part of a strategy. You have to know how to observe your chart, how to read the charts properly. That is part of controlling risk. So assuming I've now known that from the past, anytime the price is below 00, it remains temporarily. But anytime it's above, it tends to remain above for a long time. Anytime it's below for some short time. Anytime it's above, it remains above for a long time. Anytime it's below for a short time, but anytime it's above, it actually extends for a long time. That means that even now that the price was below 00, we are likely to be heading upward for a long time. So that's the first thing. Now I have an opinion that I'm supposed to buy. The next thing is to look for levels on the main chart that are obvious. Look for places that are obvious, not just one place. Look for places where there were clear turnaround points. Like now that I've known that the trend is upwards, we are likely to be continuing up. I now move to my chart. Then I realize this level here. This is what stands out for me. This is what stands out. I said this is a resistance. And then this also a very good support. This is support. Then this is another level here which appears to be standing out. So notice I'm not focusing on whatever is happening in between. Focusing on things that stand out, the extreme. There is also a level here, but I'm not going to focus on this. Was a good level. So after you know that this is now upwards, that the trend is continuing upwards, you've established your levels on the main chart like the way you have. If this is showing you a good sell, you know very well that the overall trend is upwards, but you're seeing a sell. Wait for price to break above that level, then look for a buy in the direction of the trend. That's the main thing. So I'll not find myself selling anything. I'll not sell this. I'm not going to sell anything irrespective of what the chart is saying, because the trend overall has been upward. So want to reduce your risk, first of all, ensure you understand a chart properly. That's the very, very most important thing. And I've noticed that these CFDs indices, they tend to have a particular pattern, like all of them are somehow moving upwards. So remain with only those trades that the direction is clear. If this is clear, I'll remain with it. And if this is clear, I'll equally remain with it. Like you'll notice that while somebody was busy selling a particular pair or maybe selling Brent oils, whichever, this was showing you a very good direction that we are upwards. Therefore, whatever you ought to have done in this case was to buy, continue buying, and continue buying even further. So the first step to reducing your risk is to establish clear trends, clear directions. That's the very most important thing. That somebody is saying I'm going to lose only 2% in a trade, 3% in a trade does not make sense until the strategy is clear. Your strategy must be very, very clear. And then something else, don't make your chart complicated. Don't complicate your charts. The chart has to be as clear as this one. Like you can see, I'm only having this one, having this indicator, and I'm having just a single line on my screen. What this means is this, because overall the trend is upwards from what I've just looked at. The current dominating trend is upwards. This is the next level I'm seeing. This is a level here. Then we also have a level here. So just the same way I was looking at SP500, this one also has just 3 levels. So because this was a sell place, it's the same place I want price to reach so that I buy from that place. So what that means is this: the price has to retrace back to somewhere around that level, and then it should move up, something like this. This is the very first thing you need to have in mind. You need to know exactly how to enter your trades properly, even before you start saying that I'm going to raise this amount of money, I'm going to do this and this. So the most important thing as at now is that understand good setups. Like look for things that are obvious. Out of all these charts, from the first one, all these ones, up to the last one, there's always one which is clearer than the other one. The one that looks more clearer than all the others. Your work is to get that is most clearer. So if assuming you have multiple charts to look at, you have this, you have this ones, you have this ones, but you notice that this one NQ100 is actually more clear than the next one. You just remain with this one. And if this one is the one that is clearer, there is no point of trading what's not clear, even if you hear people talking about it. The only thing you need to know is that the float, the margin that is needed to trade this one may be different from the margin needed to trade currencies. That's the only difference. But it is better to remain with these ones. Even if you're doing the minimum volume, it is the best strategy. So another thing, somebody asked me that should I let my losses float or should I let my top profits float? The answer is simple. Fix your stop loss, but then your take profits need to float in a way that they're bigger than the losses. So what that means is this: every time you risk one, is a risk of one, just ensure that there's a reward of more than one. Something like this. There's a reward. This is one thing you need to understand very, very well. This is where most people go wrong. You'll find somebody is racing 200 trade, but then when trade begins to go their way, you actually stop it before it reaches even 200. So you'll be comfortable with losing 200, but when you start earning something like 20 USD, you now get, you see the urge to stop such a trade. That is something you need to overcome. It's emotions. So whatever you choose to do, just ensure that anytime you risk anything in a trade, that risk is always like half whatever you expect to get, or the reward must be 7 or more than 2 times whatever you're risking in a trade. So if you have 100 USD in your account, maybe today you say I have this amount of money, maybe 500 USD in my account. That's whatever you're having in your account. The risk, if you're risking 10 USD per trade, just ensure that whichever pair you choose to trade, whichever index, whichever CFD, whichever you choose to trade, is that 10 which you are risking. It has to be some round value. Like if I'm trading this, I'll come here and then I'll enter that trade. Just a second, assume I've bought that. Then I'll come and then I risk how much? This is something around, I'll use this around 68, 100. That's the amount I'm risking. Then I'll also go to the next one. Then you risk the exact same amount. That's the key. So the idea is to keep risking the same amount of money and always ensuring that anytime you are earning at least double whatever you are risking in any particular trade. So the first thing is to ensure that you understand a good setup. That's the number one step towards risk management. If you don't have a good setup or don't have a good strategy, then there is nothing you're doing, because risk management and strategy goes alongside each other. You cannot say you know how to manage risk if you don't have a good strategy. It's the good strategy that now makes your risk management effective. Does that make sense? I hope that should make some little sense, that you don't trade if whichever strategy you have, whichever you choose to trade, whichever strategy you are trading, anything that you choose to trade, they have to take into account the amount of risk involved. That's where the business is. If you find yourself trading but you cannot control any risk, there is no risk strategy towards your trading, there is nothing you're doing. And if you don't have a good strategy but you have a risk management, you may appear to be good for sometimes, but when you may lose somehow. So the idea is to have a good strategy, couple it up with a good risk management. And as I've said before, part of a good risk management is to ensure that you have a good setup, look for things that are a bit obvious, and then ensure that in any trade you're trading, you're only risking like half whatever you expect to get in that trade. So if you have a float of 500 or a margin of 500 USD and equity of 500, and you say I have to risk like 10 USD from 500, just ensure that whichever pair, whichever trade you're trading, at any given time, only 10 you are risking. Only 10 you are risking. Don't risk more than that, and ensure that if you have to get something, you get at least 20. That way you are going to be safe. So to avoid multiple trades or trading several such that you lose the entire 500, look for setups that are good, that are likely to work your way. That's where the strategy part of it comes in. So you'll find somebody that they understand that very well, that I'm supposed to risk 1 to 2, but then they still lose money. It's because the strategy they're using is actually working against them. look for strategies that are a bit obvious, things that are very, very simple. That's the number one thing. There is no greater secret than keeping it simple. Don't be fooled. There is no greater secret in Forex than keeping everything simple. If you want to make money honestly, ensure that your strategy is extremely simple. Keep it simple and ensure that you also control your risk. And then look for setups that are obvious. Like I've seen this, I've talked about this one. You can already see that overally the thing is upwards. Just notice this point. Only during this time there was a major retracement. This was just before 2008. Then after that, the price went up. There was a minor retracement. It went up. There's a minor retracement. Continued even higher. Then there's a minor retracement. So I'm looking at this as retracement. Not that there are no retracements even before. There are other retracements, but these ones are major. Then it continues up, and then there's also this as a retracement. So what follows now is that we expect price to continue upwards. So you can see, interpreting the chart the way I'm doing conforms with what the indicator is saying, and that's the best case. If whatever you're seeing on the chart is being supported by what the indicator is saying, then chances are that you're correct. So you're supposed to look for a trade in that direction. There is no point, even if your risk to reward ratio is 1 to 2, and you come and sell somewhere, chances are that you're going to lose, and this is losing unnecessarily. It means you're failing to do one part of the job that involves looking at this as a trend. You have to, first of all, before you come here and you trigger any trade, understand the chart very, very well. Understand that it has to be very simple, it has to be easy to understand, and it has to be easy to explain to anyone. So if you can't explain whatever you want to sell, you want to buy to someone easily, or somebody is finding it hard to trade it, then the best thing to do is to avoid it. Like in this case, I would basically have traded this ones if I was using just this simple indicator, this simple moving average. Assuming I was only using this, then I want to mention exactly where I could have traded. I would have come somewhere here, and then I say every time the price pulls away this indicator, but then it gets back, I pick a buy. So I would have bought there. This is the first buy. This is the first buy, sorry. Now bought there. It's the first buy. Then the second buy is here. Second buy. Then we have the third buy, which is here. Third buy. So as you can see, what this simply means is that since 2011 until now, I would only have had like 3 good trades. And not something. The idea is not the number of trades, the idea is the quality of trades. It is better you trade these 2 trades in 3 months or even in 2 years than to trade 100 trades but there's nothing you're getting from them. In this case, I would wait for price to get back here, then I'll pick that buy because I'm risking something like 10, enter there, expect price to move long, and then I take my profits. Then in the event that it gets back to the same place, I pick a second buy, expecting it to push price even higher. Then if it comes back, which it did, I'll also pick another trade from this point, have my stop just slightly below. Then in case in the future price again gets back this like this, then I'll also buy it from this point. So this is the expected buy in the future if price gets back to the same place. Fourth buy. In the future, should price come back to this place here, then this is going to be the right place to look for buy from. So this is simply what you need. Look for setups that are very, very clear, very, very, very clear setups. The first thing towards succeeding in risk management is to ensure that you understand very well what you're doing. And to understand that, they have to be clear. You cannot say you understand what you're doing if they're not clear. If they're not, they cannot be explained to someone else. Your strategy should be explained, should be explainable. Like if I'm saying I'm buying here, what I'm trying to say is basically anytime when the price pulls away from that line and comes back, I pick a trade. Anytime it pulls away but then comes back, I pick a trade. If it continues up but comes back, I pick a trade. So that's simple. That's the very first step. It's not about saying you're going to risk 1 to 2. You have to get a good strategy for that one. That is the most important thing. Get a good strategy and then attach it with the proper risk management. That is what you need to do. So you'll find somebody having a good strategy, but they don't understand that the risk needs to be limited. So some people also they'll enter buy here, then price starts going their way, then even before the price hits a turnaround point, they're already out of that trade. But when the price is going against them, they actually leave the trade to go up to the stop loss. So that is one thing you need to work on. The best way to avoid it is to enter trades on the longest time frame possible. If you're somebody who is used to trading 1 minute, 5 minutes, then I'd rather you leave these time frames alone. Go to either monthly, weekly, daily, and in worst cases, go to Forex. That's what I'm saying at the moment. So if you find somebody trading 15 minutes and they say they're a professional, then you need to evaluate that professionalism properly. It is good that they may make money, but then to make whatever you're doing, to get something out of what you're doing, ensure that you're trading the highest time frame possible. This way, you'll only have to risk at this point. You'll also have to risk at this point. You also have to risk at this point. That means for the entire 10 years that this trade was upwards, I would only have risked like 3 times. And those 3 times, they're not enough to liquidate 200 USD or 500 USD, whichever amount I'm having in my account. So I'll come at this point, risk 10, risk 10, risk 10, and for every 10 that I risk, I'm actually expect to get more than 20. And assuming the price has started going my way, maybe it has gone for like 40, that's like 4 times the amount I'm risking, then I'll start trailing my stop loss manually. That's another thing. Trail your stop loss manually. Don't use mechanisms or the way that's provided by the MT4. You should trail them manually. So the first step, as I've mentioned, get a good strategy, a good setup. Look for things that are a bit obvious. Don't try to force anything, and then ensure that you're in line with the overall direction. So whatever is obvious must be in line with the overall direction. Then that is where now you input this risk strategy. After you've known this is now upwards, I've found my levels, then I now know this is the entry point. Now I begin to say that I'm going to risk 1, then I'm going to get a reward of 2 from this trade. So that is it. There's another thing which I want to say. I want to look at this as an example. Assuming you are looking at this chart, if you load this chart and don't understand anything happening on it, leave it. Don't bother so much. Like in this case, I cannot find anything that I'm understanding, I leave it. But if you notice that by drawing a line here, it looks much more clearer, then you better remain in that one. Only trade when the price is at this level. And then now you'll say that every time the price comes back to this line, I pick a buy. But that buy, there's a fixed stop loss, and that stop loss is not more than half what I'm going to get from it. Then I'll come at this point, pick a trade, come at this point, pick a trade, and when the price gets back to this point, I'll also pick a similar trade. So I want to look at gold. Let's see gold. Gold is here. Gold is here. So the one most important thing is that just ensure that your chart is very clear. Understand perfectly well what you're doing. There's this one. Somebody just comes to this chart and then they draw a line like this. You realize instantly that this line has been holding. So what this simply means is this is a level here that's holding. just look at how long it takes me to pick that line. It doesn't take even a minute to see that this is a level. It does not take any time. It takes literally no time at all to see that this is a clear resistance. So your work will be simple. Don't risk that one trade, the amount you're risking. Don't risk it anywhere where the price is not clear or when the chart is not showing you something clear. Risk it only in places that are very clear. Like in this case, you can see that this has been a turnaround point from the past. Price has been holding below it. We have this. We have this. This is basically a resistance, a resistance, a resistance, a resistance, a resistance, a resistance. This follows that in case the price gets back to this point in the future, that is still going to be the correct place to sell from. So the first step toward controlling risk is to ensure that whichever trade where you want to trade, whichever pair, whichever symbol you're trading, if you find a level that looks like this, ensure that you only risk on such places only when the price is there. Like in this case, currently the price is here, but I'll wait for price to get back up to within this level. Wait for price to get back up to within that level, within here, in there. Then you pick a sell from that point, expecting the sell to push price up to this support. So the most important thing is not actually how many trades, is how well you enter trades. If you don't know how to enter trades but you have a proper risk management, then that risk management may not help you, because you'll risk 10 here, risk 10 there, while you ought to have waited for that one trade and only risk 10 at this point. So somebody may think that this will take time, that for waiting for price to get up to this place may take months. No, sometimes it can take months, but sometimes it come back immediately. So be patient, wait for price only at the correct places. So if, assuming it's taking months to get to this place, there are several charts here that you can trade. There are a lot of symbols here which you can trade. Load any of them, look for any chart that is clear as this one, and ensure that it is close to that place or it is within that place. Then you trade when the price is there. So I hope that should make some sense for now. Should make some good sense for now, that we are basically waiting for price to get up to this level so that we can pick a sell only when the price is there. So you can notice that the chart I've been loading here, they're actually a bit clearer than normal. That does not mean that other charts are not clear. Majority of these charts are always very, very clear. You can always find very good trades if by looking at this ones. There are a lot. So your job is simple. Wait for price at this place, pick that trade, define your risk very well, ensure that that risk is not above whatever you expect to get. It's not above half what you expect to get from that trade. So another way, I can also wait for prices here, only on clear places only. If that place is a support, this is another dynamic support. When price gets to this place in the future, that's the third time, this was now a very good trade for me. And if price can get back again in the future, that is still going to be a very good place to look for a trade from. Like this. So this should make some good sense. I hope you understand this very, very well. That even with the best strategy, if your strategy does not take into account the risk involved, there's nothing you're doing. That's one thing you need to understand, that if your strategy fails to take into account the risk that is involved in a trade, then it's not helpful. That's the truth, because you can see that if somebody was literally following this, if you are trading blindly from this point, you could possibly have sold there, price went your way, could possibly have sold there, price still went your way, could possibly have sold there, which it went your way, could also possibly have sold there, which price still is going your way. So the idea is not to have many trades, just have 2 trades. Even if you're having like 4 trades in a month, 2 trades in a month, ensure that you enter correctly and with a better volume. That way you're safe. That way you'll make money. If you are waiting for price to reach here and it has taken like 6 months for price to get there, it's okay. It is really, really good. It's constructive. You'll make good money. Just ensure that you enter there, you have a very good volume, and then your stop loss is also controlled. For every one I'm risking, I expect 2. For every one I'm risking, I'm expecting 3, at least above 2. So that should bring us to the end of today's webinar. So far we've learned something which I think I've not mentioned, some I've not mentioned, and I've said that the best procedure to start controlling your risk is to ensure that you have a good strategy. Have a very simple strategy, something that is very easy to explain, and then ensure that you only trade when the strategy is made. So that is one thing most people don't understand, that risk and strategy, they're the same thing. A good strategy must have risk management incorporated in it, and a good risk management must also have a good strategy attached to it. So there is no way, they cannot work in seclusion. You cannot have a good strategy without a good risk management. And if you have one and lack the other one, you will not make money still. You may make money maybe temporarily, but ultimately it will be a negative on your side. So thank you very much. See you again tomorrow at 7:30 GMT.